Hello, family. I just wanted to come to you today and talk about purchasing and selling options. I know there's a lot of people interested in it. How do I make buys or sells with just a little bit of funds? Let's say you only got 200 bucks. That happens. If you only have $200, you might not want to buy $200 worth of stock. So if let's say you wanted to purchase American Airlines, today it's at $22.78 and it's doing a dip up, down. It was up to, I think, like $25 a share last week, which was great, but now it's dipping down. So you might not want to actually buy this stock at this time, but you want to maybe try to predict what it's going to do in the future. And if you want to do that, like air travel is coming back, there's several different variants of um, the virus, but they're coming out with different vaccines. So if you're like into that and you're predicting that future, this might be a stock that you are interested in. I, disclaimer, own American Airlines, but I bought it back when it's like $14 a share. But that's my buy and hold. I'm not, I do sell call options on it, but that's it. And I might go over that with you on how to sell a call option on it later, but I just wanted to go over what you're looking for when you're purchasing. So when it comes to American Airlines, you know it's not a company that's just going to disappear overnight. So that's one thing you want to look into. You want to also review its charts to make sure you're following whatever trend is going on. It is an overall upward trend, but that's over years. If you're going to do a short term call or a short term put, you need to make sure you're reviewing like over the last month. So over the last month, there was a big jump up to 24, but now it's heading back down. And I'm thinking the trend of this is probably going to bottom out at like 18 or 20 before it goes back up to 27. That's my prediction. Don't quote me on it. And don't use it to make any purchases. So let's take a look at how would I buy an option using Robinhood, because this is the easiest platform that I find to buy and sell options on. Schwab is a bit confusing. It uses different vernacular grammar than this. And I believe that Robinhood is made for the layman, and I am okay with saying I am a part of that group. So I appreciate the simplistic nature of Robinhood, even though a lot of people are mad at them. I still use them. So that's what you're getting on this channel. All right. So let's say you want to buy a contract on American Airlines. The first thing you'll do is go to the Trade AAL options button. So the first thing that comes up, and you should pay close attention to, because I made this mistake several times when I first got into options, is you got to make sure you have the proper radio dial selected. I went to go and sell a call to close, and I accidentally bought more calls. So make sure you got the right one selected, or else you might have several calls options out there when you meant to close your call option. So right now we're looking at buying a call. And that means I'm going to request out there in the netherverse the someone who wants to sell me a call. I want to buy it. And why would anyone want to sell a call? Because they want it to make the premium. So if you own 100 shares of AAL, you might want to sell a call so you can earn that premium to people like me who want to risk it that the stock price is going to go up, but most likely it won't. Most call options do expire worthless, which is great for the person who owns the 100 shares, not so much for the person who purchases the call option. However, if you do it like I say to do it, you will make money as opposed to just letting your options expire worthless. All right. So with this one, I have buy a call highlighted, as you can see in dark orange. If the stock price was in the green, this wouldn't show up as orange, it'll show up as green, just to let you know. So don't let the colors fool you right now. It's only because of the stock price is going down. So the next thing you want to look at is your strike, not your strike price, but the date you want your stock to expire. If you've been watching this stock go up and down, and you know about it takes a week for it to get to a certain price, these are things you should know before you make these purchases. If you know it takes about a week or 2 weeks to get to the price that you're trying to get to, you need to make sure you put that into your date. Now, I understand it's a lot cheaper to buy options that are closer to today, but you might not make your strike price by the date if you try to go cheap and go close to the day. Now, what do I mean by that? If I chose this one, this expires this Friday, which is April 1st, the day before my birthday. So if I chose to purchase this option at a strike price of 22.50, right? And here comes Friday and the price of the stock is 22.50, you're going to lose money. Why is that? Oh, you're saying I hit my strike price. How in the world am I losing money? Because you had to pay for this option and you paid 74 cents per share. So $74 of your money was paid to the person who's actually holding the call. So you don't have to just make the 22.50, you have to make the 22.50 plus the 73 cents. So that would be considered your break even price. Okay. Break even price is all well and good because then you didn't lose any money if you make it to the break even price, but technically you did. So if you're buying a call, now if you're selling a call, and you make it to your break even price, it's okay because you collect a premium and you still own your stock. And that's why I prefer to sell calls as opposed to buying them, but I do it anyway, when I want to gamble. So when it comes to buying calls, you want to choose a strike price that you know is going to hit. You might even choose a strike price that's in the money. So in the money would be anything underneath what the current price is. So any of these inside the money would be a good one to choose if you're buying a call because then you're making money no matter well, you're getting your money back no matter what. However, if the trade goes completely south and let's say next week AAL tanks and it goes down to $18 and you're holding this call for $22, you've lost your premium plus you're not going to make any money. But the good news is you only will lose your premium as opposed to whoever sold you that call, they can't sell their stock at that point because they're holding the call. And then if the price tanks down to 18, you don't incur that loss, only they incur that loss. Okay, so that's a benefit in purchasing options. So let's move on. I think I covered the call option pretty well when you're buying. Let's move on to selling a call option. So you would select sell, call, and you say, oh, I want to sell a call for the next week. I own 100 shares of AAL. And I think that the price is going to go down. And while the price goes down, I'm not selling because I'm a proud owner of AAL. I understand the price is going to go down. I understand the price is going to go up, but I think it's just going to either go down or sideways or stay the same, right? So by next week, if I say the price is going to be like, we'll say 21 bucks, right? So if I think the price is going to be about 21 bucks, you, as a call owner, do have the right to sell your stock at a strike price of $21, and you will make $192 for your trade. However, if that price at any time ends up above the price you chose, you will lose your shares, and then they will give you the money. So I would end up with the $21 per share. I would get that. So I'm not like losing everything, but I would get the $21 per share. And then whoever bought my stock from me would get the stock. And then, I would, whatever price it ran up to, I would lose out on that. This is the downfall of selling calls. If I ended up selling a strike of 21, but the stock went up to $23 a share, I lose out on all this money because I sold it at $21 a share. That is why if you are selling a call option on stocks you own, always choose a price you are okay with selling at. So, and then you just got to suck it up if the price ends up running. So, For instance, I sold a call option on HL, and I sold it at like $1.50 above what I owned it at. So I would have made $1.50 per share or whatever. But I was like, man, I want to keep that stock. I want to keep it. I don't want to sell it. And for some reason, it jumped up like $2.50. And I was like, no, I'm missing out. And you know what I should have did? I should have did nothing. I should have just let it go. I should have let the stock go because I chose a strike price I was happy with. And I ended up buying that option back. And so it was a wash for me, a complete wash. I got to keep my stock, but the price ended up dropping back down to where I originally sold it at. So it was a complete wash. And I wish I would have just let it go because I made the decision and I should have stuck with it. And that's the biggest thing you need to do with options is make a decision and stick with it. Don't change your mind because 99.9% of the time, your first instinct is the correct one. And by the time the option comes to a close or near the closing date, it's going to be right where you predicted it. And I've closed a lot of options early because I thought I was wrong, but I was right every single time when that strike price came. I was like, dag nabbit. I wish I would have just listened to myself. So now I'm just like, if I lose, I lose. I'm going to stick with my first instinct and I'm going to ride it out. So it's up to you if you want to sell calls. I sell calls on the stock that I own because it's free money. And in the event they do take your stocks away, you can always buy back in. And 9 times out of 10, the options will expire worthless. They will. And then there's that one time that they do get your stock, but you get the money. You get it. So it's not like a complete loss, if you can just be okay with missing out on that upswing that one time. Okay, so that's my message on selling calls. When you sell a call, choose the strike price you're okay with selling your stock at, and choose the strike price that makes sense for the cost or the premium that you're going to receive. Like if I would had 100 shares of AAL today, I would be like, I want to sell it for at least $25 a share at the very least. So we're looking right in this area. I could do 25.50. If I sold it for 25.50, I'm getting 6 cents. Is it worth getting 6 cents per share on a call option, right? As premium, is it worth it to sell this option to me? It is not. It's not worth the risk. So yeah, you'll end up collecting $25 per share, but 6 cents isn't worth it. And I wouldn't sell it. I just would not sell at that time. But you know what you can do? It's only 6 cents because it's April 1st, and no one believes that by April 1st it'll be 25.50, which is understandable because what is that? April 1st, it's Monday, so by the end of this week, I doubt AAL jumps $5 or $4, right? It's not. I mean, it's possible, don't get me wrong, but the likelihood is very low. That's why no one's willing to pay for this option. And I understand why they wouldn't be willing to pay for that option. But if I bought this for $14 like I did, and I was like, oh, well, if I sold it for $23 strike price, I'd be okay with that. Is 49 cents per share a good profit? Yes, it is. It's a very good profit off of this trade because at 49 cents a share, you're looking at uh, $49 per contract. $49 per contract. So if I had 2 contracts, that's a good $98 per week. And if you can roll that times 52 weeks, yeah, that's $5,000 ish a year. That'd be a good little side hustle, wouldn't it, if for your stock if you just kept selling calls and making your little $90 a week. It makes sense. So that's my 2 cents on selling calls. Now we'll go to buying puts. Why would anyone want to buy a put? If you know, don't be insider trading, but if you know that something's around the bend, like if I knew last March about the coronavirus, which I don't watch the world news. Maybe I should, because if I was watching the world news ever since the previous, I think it was August, everyone was reporting that this virus was out there. And so a lot of people knew it was coming. And when March happened and everything shut down, a lot of people were smart enough to get out of the game and purchase ZOM. Um, which was like I wish I was in it like that, because that would have been a great purchase to get Zoom, and then sell out of Carnival would have been like the best thing ever. But no, I was still in Carnival come March. In fact, I had a cruise planned March 16th that got canceled. So I was all up in the Carnival cruise line which when it went down. So if I was in it like that back then, I would have bought a put on Carnival at 45 bucks, wherever it was, because that those puts, like when Carnival dropped down to $8 a share, you would have gotten all that money, all of it. So if you see something on the horizon, or you have a knowledge of a tank about to happen, that's when you would buy a put. Or you hear some bad news about a company in the news, that's a good time to buy a put. So on AAL, if I found out that they had to shut down half their fleet, or if they had Boeing planes and Boeing had an issue, their price would probably drop. So I would come in here and be like, I think, you know, worst case scenario, their stock might go down to $15 a share, which would be awesome for me. Um, So the way puts work is you would buy at a strike price, right? And if this green line drops below the strike price you bought it at, so the price has to go below the price that is your strike price, you would gain all the gains from there, because you're getting a contract from someone else to sell stock at a certain price. So these prices down here are in the money, because right now, if I were to buy this stock at $22 per share, the price is 22.85. That's 85 cents over the price that I'm buying it at, and that would be your credit. Like that would be the money you'd be making. So, and if the price just kept tanking and tanking and tanking, right, then you'd make even more money. So the lower the price goes, the more money you make. The higher the price goes, the 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 less, well, your option would be worth nothing at that point. So if the end of the call or end of the put, if the price was 23.50, you get nothing. You lose out your money, you get nothing. But if the price ended up being $21 and you bought it at 22, you would get everything in between 22 and 21. That's why you would want to buy a put. Now, if you're like me and you're broke as a joke, you might not want to risk it. That's risky, right? Buying puts, that's risky. This is where everything started for me, selling puts. Stay away from calls if you're just starting out. Stay away from buys if you're just starting out. Stick with selling. Now, when you sell a put, always sell a cash covered put when you're starting out. What does that mean? It means you have to have the cash to cover 100 shares of whatever you're selling. And this is easy money, like easy money. Okay. So what you'll do is you'll say, "Oh, I wouldn't mind owning American Airlines." That's the first start. You got to say you wouldn't mind owning it, and I wouldn't mind owning it for 5 years. Okay, so that's what you got to start with. I don't mind owning this. Don't be selling puts on crappy stock. Don't do it. You make sure you sell it on something that's going to be around for a long time, and you don't mind owning it. And maybe even if it sells a dividend, or if it gives you a dividend, that may be another reason, because then while you're owning it, if you get stuck with it, they will pay you a dividend. So you're not just sitting around twiddling your thumbs. So if you want to sell a put, so you're selling a put on AAL, I would choose a price that I'm okay with owning it at. Obviously, it's going to be less than what it's selling on the market at, because if I wanted to own it at that price, I would just buy it now, wouldn't I? So if I have enough for 100 shares, all right, and I want to own this at $21.50, okay, $21.50 times 100 shares is what I would need in my bank account. So that's $2,150 that I would need to make sure I had in my bank account or my Robinhood account, sorry, to cover the call. And what I would say is I would select that I'm okay with selling it. And this right here is the premium that you will receive per share for saying you're willing to buy it at 21.50. So that's 15 cents per share, which gives us 15 bucks. So if you do one contract, you'll get $15. If you do two contract, you'll get 30, and so on and so forth. Now, in some ways that might not be worth it to you. In other ways, it may be worth it to you to do this. Most of the time, I try to stick with $100 altogether. So $1 or more for when I'm trying to sell puts because I want to make it worth my while, right? And then in the end, I hope they don't actually go through because I don't want to own the stock. So on this one, just to give you an idea, your break-even price would be 21.36. So why would this matter and why do you need to make sure you're willing to own something? Let's say you said I'm okay with a strike price of $21.50, right? But this stock ended up going down to $20. You would be owning the stock at 21.50 no matter what. Even at the end of the day the price came out to be $20. So just keep that in mind when you're selling puts. Why don't I see that as a bad thing? Because you bought a stock that you know is going to bounce back. And once it bounced back, you can sell it and get the cash back. Now, if it does go down to $20, you can sell some covered calls. And that's what I normally do. I sell the puts, get assigned. If I get assigned, then I'll sell covered calls until it goes away. And once goes away again, then I start all over again. That is called the wheel strategy. And it's a really good strategy to make like $200 to $300 here and there. A week, maybe a month, depending on how much capital you have in your account. You can make a good two grand a month off of just having like 700, not 700, but $7,000 in your cash account, and it's all covered and secured, and there's no way you would lose money unless you sold at a loss. So if you ever get assigned something and it goes down in value, just don't sell it and you'll never have a loss with doing the will. Now, I will make a separate video about doing the will because I mean it's an easy money maker if you're okay with making small amounts here and there. So as you can see, you can sell puts and make 37 cents per trade. Now, American Airlines is on the small side. I don't like to do big big options because then you get into having to do splits and I I try to keep it as simple as possible for myself. So if you really want to learn about options, I do recommend taking a course. Personally, I just keep it simple. There's so many ways you can make money, but I do prefer to keep it simple.